You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome back to the show, Bob.
Yeah, Jim, good to be with you. I've been doing a little traveling during the week, and we're up in the sunny Okanagan in the lovely city of Kelowna visiting friends, but still, here we are. We can do a show.
Widening credit spreads.
Yep, we of course follow that one very closely. It's a portion of the market that the Federal Reserve and any other central bankers can't push around for any length of time. So we watch them closely because when it's party time, which was the case earlier in the year, credit spreads narrow, and that's the difference between treasuries and BBB bonds. That's the one we use, corporates. And we expected earlier in the year that narrowing would take place into around May or June, and that would be very beneficial for financial markets and commodities and things like that. And then it did. It reversed and began to May and June, and then we set out some technical levels that needed to be exceeded, and that was breaking to a near new high in early July, and then to a really big high breakout later in July. That came in early August. So, and this is, of course, what prompted the heavy liquidation of stocks, and basically, first of all, in China, and then following the rest of the world. So it worked very well for us, and indeed came right down, widening on this one spread right down to the Black Monday crash, if you will, on August the 24th, and that spread got out to 229 basis points. And then, of course, that was a panic. It was, really get me out of here kind of market. So that was the extreme. So that week, when we published on Thursday, we felt that the relief in the spread market and a lot of other things, at least on spreads, that you could have narrowing back, for maybe 2 weeks, maybe a little more. Well, the week just passed was the second week. And the spreads did reverse during this past week to widening again, and close on Thursday was 227 basis points, and the worst was 229. So this is the bad direction, and if it breaks out, that'll be another warning on another phase of forced liquidation here. That would involve most stock markets, and the spreads will continue. So this is the thing we were looking for. It's not going to be welcome, and we also want to remind people that the senior central bankers, have no influence on the curve when it is ready to change, and even then, and also on the credit spreads. So even the old TED spread, which we used to follow decades ago, it's been widening. That's the difference between short-dated interest rates in Europe and in the United States, and that's been widening. So let's call it another warning.
What about the Fed's Janet Yellen? She keeps hinting she's going to raise interest rates before the new year.
Well, isn't that a story? I think, and we've been talking this, Jim, that maybe the Fed cannot raise interest rates, short rates. We know that they can't push the curve. We know that they can't push spreads. And what if we're in a world where, like the 1930s, where the safe money goes to the most liquid items, which happens to be U.S. Treasury bills, and that bids yields down, and I think it's maybe more than a year now that they've been talking about the big raise in the Fed administered rate, but it doesn't happen. So, ironically, perhaps that talk about raising the rate is just like waving a flag and saying, oh, we really can be responsible if we want to be, because they've been hammering, issuing credit as hard as they can. And then even, as you mentioned earlier, they're talking about negative interest rates, which we can bring up later on. But you've got, this is very exciting times, because the markets are not doing what central planners want them to do. And it's sort of like a clock being correct twice a day. There are times when you get a business expansion, and there are times when you get a bull market for stocks, and then there are times when you get spread narrowing, which usually goes with a bull market for stocks. And that all happens. And then those periods, it makes the central bankers look good, like wonderful things are happening, and they're, of course, not shy in taking credit for creating all these wonderful things, but it's the public that does that. So it goes back to, we saw one recently here and did one where the widely followed commentator John Malden in his last week's piece said that stated the legend that Paul Volcker personally ended inflation in 1980. So I wrote a piece pointing out that the peak in commodities in 1980 was very similar to the peak of commodities in 1920. That one peaked, crashed. The Fed didn't like weak commodity prices and eased money, not knowing that a financial bubble was developing, and that was the 1929 one. So you have this here, that you have an era of when tangible asset prices go up, like commodities and wages and stuff like that. Well, that peaked in 1980. Volcker just happened to be on as the Fed chairman then. It happened during his watch. But anyways, commodities burned out and crashed, and then, like in the 1920s, the action shifted over to rising financial asset prices. And that transition was magic, but it was the same thing as happened in the early 1920s. So then, of course, what is different now is that it took a long time before you finally got up to the 2007 bubble, which had many of the characteristics of the 1929 example, or earlier than that, the 1873 example. So what we have been on lately, out of 2009, is the first business expansion after a classic crash, and the first bull market in financial assets out of a classic crash. And both of these, for the last 3 or 4 months, have looked very mature. That the economy, and then there's been some numbers, leading indicators and whatnot, that are suggesting that the U.S. economy is beginning to flatline. And of course, we've had the completion of a fabulous bubble in Shanghai in June, which was the month that it was likely to peak. Also, by the way, remember in that one, we needed to have our upside exhaustion model come in with a cluster of readings in June, and which would be similar to the cluster of readings in 2007 for the Shanghai stock market. And they came in, but we only got one, but it was enough. So Shanghai peaked on June the 12th, and then we all know the rest of the history now, right down to a Black Monday. So with the rebound we used the S&P, I guess, a week or so ago to point out that we needed to get a certain momentum out of a CCI indicator. I think it was around 100. And we did reach that a little more than a week ago. And then with that rebound in momentum accomplished, then we were looking for the senior stock indexes to go down to at least the lows reached on Black Monday, and they're approaching the low closes, but they're not yet at the extremely low intraday extremes. So, but this is not friendly to normal type of investing. So it's our view is just to stand aside.
Well, I was just going to ask, what happens when a company needs to raise money for a new venture? Is anybody going to put money into the stock market right now?
Well, that was the part it showed up in many stock exchange new issue market, or as they call them now in the States, IPOs, initial public offerings, and that was huge in China in the spring. And that's also only takes place in the during the speculative mania. And of course now this is now shutting down the ability to raise new stock issues. And then with the lower grade corporate bonds underperforming, declining, that's beginning to close that window as well. So the financial markets were open, party time. The party, well, as the saying goes, that when the Federal Reserve is the bartender, everybody parties until they fall down. And we're now looking, the fall down period was from, well, the U.S. market, I guess, had its peak in July. Our July 23rd piece said that it looked like the bull market was over. And more recently, our read on it is that this hit, if it takes out the Black Monday lows, then it would be registering a cyclical bear market. So let's wait until we get there, see what happens. But the probability is that we're in the contractionary period. Commodities were likely to be firm up until around May, and they did do that, and that would include precious metals as well. And then I just checked earlier today that the commodities are doggy again. They're not yet at the lows of a month or so ago, but they're not strong. So, and credit spreads widened on the week. Commodities were not strong, and the stock markets weren't particularly strong during the week. ADs, there's another one. The advanced decline line, which action peaked in April, reversed in May, and then there was a critical breakdown in the advanced decline line on the New York Stock Exchange in July, and that then was part of the negative. So then what we have had out of the rebound since August 24th is a choppy swinging around of the advanced decline line, but it looks a little like in the action in July, and it was heading down on the week. So it takes out a certain low next week, and then, hey, we're back into, and often there's seasonal weakness can be found in September, and this time it was August, and then the other month where seasonal weakness can be found is October. And so the odds are that we would have another washout here, and as we mentioned, Jim, going through the lows of August 24th would set then a cyclical bear market.
We'll answer some questions when we come back from the break with Bob Hoye.
Unbelievable harmonies, spectacular performance, Bird Dog and the Vintage Electric Band, the ultimate tribute to the Everly Brothers and Simon and Garfunkel in Oliver, October 2nd, in Kelowna, October 3rd. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with market historian Bob Hoye. A couple of questions for you, Bob. Brad wants you to please explain the impending bond revolution.
Yeah, we sort of refer to it as the bond revulsion. And in a deflationary period of credit contraction, where in the previous boom everybody was in love with every class of bonds, and then you find that the lower grade bonds, whether they're issued by corporations or countries in the sovereign debt market, it gets difficult to service. By servicing bonds, I mean paying the interest and paying off the notes, and that gets very very difficult in a contraction. So then you get to the point where the buying side says, "Hey, I'm out of here. I'm never going to own a bond again in my life because they're so bad." Well, that has been the feature of many post-bubble contractions, and indeed, if you look at 1932, which was July, which was the bottom of that terrible crash when the Dow fell something like 85%. And I remember going through Barron's week by week then, and there was no news as the stock market bottomed, like there was no policy news, everything else. But if you looked at it in detail, the continuous selling of bonds at any price, the supply just dried up and they stopped selling bonds, and then in an instant, in 1 week, the stock market jumped and the bond market jumped. So That's what we're looking for. What we're looking for is the revulsion where people hate bonds of most classes, and particularly lower grade bonds. So that's yet ahead of us. And thanks, Brad, for the question.
And now we have a question from Chris Barsky. He says, with negative interest rates, how far can the Fed push short-term interest rates? Will it be low enough to entice speculators to put risk on trades and reignite the credit mania?
Yeah. Well, the Fed has the belief that if they provide credit actually it's what we call a primitive syllogism, and economist types 3 generations ago looked at the business cycle and they noticed that when business is going up, credit expands. So you have a business expansion and a credit expansion. So in logic, there's this condition where the 2 things are happening at the same time. There's a tendency to say one causes the other, and this is what the economists have done, interventionist economists. They've assumed that the credit expansion forced the business expansion, so if they then artificially force credit into the system, they will get a business expansion. But as the last couple of decades have shown, if it's time for the public to speculate in financial assets, they will. There's nothing the Fed can do about it. And when they get burned out, then it collapses, and there's nothing the Fed can do about that. But I hope that they can all take some lessons, like senior central bankers take some lessons in logic. It would be a nice step at rehabilitating the whole of the economic studies thing. So negative interest rates, I think they accomplished them briefly in England. That's where, or in Europe, where you put your money in, say, like the equivalent of a T-bill, and then at the end of 1 month or 2 months or 3 months, you can take your money out, but you get less. Whereas if you put your money into a T-bill and there's some minuscule interest rate, you take your money out plus a bit of interest. So it's just taking this idiocy by the central bankers and interventionist economists to the limit, and it won't ignite another phase of speculation unless the speculators are willing to speculate. And speculators these days are very much conditioned by margin clerks, and the margin clerks have an entirely different job description than your basic central banker. Central banker's job these days, and this deals with this negative interest rates, is to try and get the accounts, the brokerage accounts, out of line. Whereas the margin account, his job is to get them in line. And in every contractionary phase, the margin clerk has the power and the central banker has less power. So let's just look at the seasonality here. The level reached at the close on most stock markets on August 24th. That's the target. And if it goes below that, and particularly below the intraday lows on August 24th, then we're in a cyclical bear market that nobody can do anything about except try and trade it.
Well, in North America, we have de facto negative interest rates. Banks charge you super high service fees and very little interest on your account. So you're already paying them to hold your money.
That's a good way of looking at it, Jim. The other one is more historical, is that you take a look at real interest rates, which is the interest rate minus the rate of inflation. And typically in a boom, that gets negative. Your net of inflation, you're getting a minus return. So that happens in every bubble. And then after the bubble is over, in the senior currency with the senior bond, the typical increase has been 12 percentage points, and that is a horror show. And that gets us back to Brad's question about the bond revulsion, is that the horrendous rise in real interest rates like that, and it's happened many times after each bubble, is that then the public and the authorities are chastened. The rise in real rates stops the abuse of credit, otherwise known as a new financial era. So we watch this one. We haven't published anything on it recently because it's all been positive side, but at some point here, real long interest rates will take another move up, and that'll be part of the next phase of contraction. And then with that, somehow it works too, the gold-silver ratio heads up as well, though that's sort of like the metallic credit spread. So the wrap for the week, Jim, I would say, is the turn to widening in credit spreads, and that will be what we'll be watching for next week.
Bob, thank you very much for chatting with us.
Always good to be with you, Jim.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. You can forward questions or comments to info@HowStreet.com. And you'll notice we do answer those questions. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.